Hi there, welcome to Kneppy Invest. Let's continue our journey looking at the 30 best performing companies on the ASX since 2013. In fact, the word I should use is the companies that perform the best, not performing companies. And I'm not looking at financial performance, I'm looking at shareholder returns. So in this video, we're going to go through those companies ranked between 25th and 21st. Previous video, I went through those companies ranked 30th to 26th. So this is sort of like a countdown. Now, before we have a look at the best performing companies between 25th and 21st, we'll also have a look at some of the worst performing companies and also go through some very important points in regards to this top 30 list. The first important point is this is not my opinion. This is not a subjective list. It's actually an objective list, looking at or based on total analyzed returns over the past 10 years. That's all I did to rank these companies, is looked at returns over the past 10 years. You might call it share returns or analyzed returns. So that means share price plus dividends. So share price increase or decrease plus dividends. I used Guru Focus to find these 30 companies. In fact, I went through every single company and there was about 150 companies. When I say 150 companies, I'm talking about non-mining companies and revenue generating. So you won't find any mining companies in this list. And also you won't find any companies that haven't generated revenue over the past 10 years. And that includes one very important company that's in my portfolio, New Rand Pharmaceuticals, whose share price has run up significantly in the past year, but they are only now generating revenue. So that's a very important point. Non-mining, revenue generating companies. And I'm only looking at companies that have been listed on the ASX since 2013. So you won't find WiseTech on this list. If I looked at the last 5 years, more than likely you would find WiseTech, and WiseTech would be towards the top of the list. And I'm only including companies that had a market cap above $1 billion as of the 31st of May, 2023. Now, to be fair, I did have a look at those companies that have performed quite well over the past 10 years that had a market cap below $1 billion, and there weren't many. And that sort of makes sense, because if companies have performed really well over the past 10 years, more than likely the valuation of those companies have increased significantly, and a pretty good chance they've increased to a market cap above $1 billion. But there are still some really good performing companies on the ASX, still with a market cap less than $1 billion. In fact, I might do a video on that very thing. And this might be the most important point. Past performance is not a predictor for future success. So just because these 30 companies have performed the best on the ASX since 2013 does not necessarily mean they're going to be good performance over the next 10 years. And in fact, in the previous video, I used the example of Microsoft between 2003 and 2023. You can divide that company's share returns into two 10-year divisions or segments. So between 2003 and 2013, the company share price went sideways, even though the company financials were growing, revenue was growing, profits were growing, share price went sideways. And then between 2013 and 2023, Microsoft has given significant shareholder returns back to the shareholders, because not only has the company seen really good financial expansion, the company has also seen multiple expansion as well. The PE ratio of this company has grown through time. Now, between 2003 and 2013, even though the company saw financial expansion, they also went through a period of multiple contraction, which is why the share price went sideways. So the most important thing here is past performance is not a necessarily predictor for future success. So ideally, what we want to find out is those companies that are going to perform the best over the next 10 years. And even though I'm looking in the past, we can draw some conclusions from those companies that have performed really well over the past 10 years to draw up a list of companies that might perform best over the next 10 years. And another thing we can do is look at the worst performing companies on the ASX. to see if there's any discrepancy between their financial performance and shareholder returns. So what I'm doing here is looking at the worst performing companies, and I'm searching for companies with pretty good revenue growth, earnings per share growth, dividend growth, but haven't seen any significant increase in their share price, just like Microsoft back between 2003 and 2013. Now, going through this exercise, I did not expect to find any companies. And in this list of 5 companies, we don't see any of those filters coming true. For instance, Boral, GrainCorp, Westpac, Monadelphous, and Vicinity Centres, these are not the worst performing companies. In fact, these would be listed between about 16 and 20. But all these companies, apart from one, had negative revenue growth. All these companies had pretty bad earnings per share growth, apart from a couple. And all these companies, except one, had negative dividend growth. Those are not the sort of things you want to see for companies in your portfolio. Return on invested capital, fairly low for all these companies. And that is fairly typical for these worst performing companies. They tend to have fairly bad financial growth, in fact, financial contraction in many cases. And also their return on invested capital tends to be quite small. And the analyzed returns for all these companies are between 2.2% and 2.9% per year, which is just around inflation. So if you held these companies and only these companies in your portfolio, you did pretty mediocre over the past 10 years. The first company on today's list is without doubt the most surprising company, in my opinion, on the list. I have done zero research on this company, NIB, which is like a health insurer, that sort of thing. I believe their ticker code is NHF, and I haven't heard much about this company. But when you look at how this company is performing financially, revenue growth 8.7% per year, and that's revenue per share growth, by the way. Earnings per share growth of 8.6%, dividend per share growth of 10.5%. That shows you this is a solid company. That's pretty nice growth. Return on invested capital 12.3. That's exactly what I'm looking for in an investable company for the long term. And an analyzed return of 18.14% per year. You would definitely take that in any company that's in your portfolio. Now, my only concern about NIB is that the analyzed returns are significantly higher than the revenue, earnings per share, and dividend growth, which means over the past 10 years, we have seen a bit of a multiple expansion with this company. So the PE ratio has grown over time, which means the market is more and more willing to pay a premium for this company. And maybe that's justifiable, because this company is in a much better place in 2023 than they were in 2013. So just keep that in the back of your mind, that there has been a little bit of multiple expansion for this company. But overall, this company has performed really well financially over the past 10 years, and that has translated to the share price. So congratulations to NIB. And it just shows you that sometimes you can have a bias, which I had with NIB. And I think the best thing to do is to challenge your biases time and time again, which I didn't do with NIB. And when you look at the long-term chart, this is a weekly chart, and all the charts in this video are going to be weekly charts over the past 10 years. This is exactly the sort of chart you want to see for a company you have in the portfolio over a 10-year period. Share price of NIB has increased from about $2.20 to a current share price around about or just below $8.80. The reason I want to say $8.80, which means this has been a four-bagger just in terms of share price over the past 10 years. And that doesn't include dividends. So this has been a great wealth winner for shareholders over this time period. Not only that, the share price is almost at an all-time high. Share price keeps on going up. A really good period between 2013 and 18, share price of this company just kept on going up. Little bit of volatility between 2019 and 2021, which is understandable, COVID-19 period. But after that volatility, share price has moved back into a really well-defined uptrend. And it was showing no signs of ending of this uptrend anytime soon. The next company on the list is a company I absolutely expected to be in this top 30, and that is REA Group. In fact, I could argue that I probably expected this to be a little bit higher, coming in at number 24. So REA Group is a growing company. Revenue per share growth of 15.8% per year. Earnings per share at 9.1%. I probably would prefer that to be a little bit higher. Dividend growth at 16.6%, exactly what you want to find. And return on invested capital, 18.1. So everything you see with REA Group, the financial growth, return on invested capital, should suggest that this company's analyzed returns are going to be quite high, and they come in at 18.3% per year. In fact, when you look at the total return and just the financial growth of this company, there's actually not a lot of multiple expansion here. And that will become quite obvious when we look at the chart. So you could see some multiple expansion with REA Group from where it is now. I think the PE ratio is like 45, and the PE ratio has been significantly higher than that in the past. And I am a shareholder of this company now. I was a long-term shareholder of this company. In fact, I bought into this company back in 2011, 2012. And then I sold when the share price got up to ridiculous levels, $180. And I've recently bought back in. So that just shows you that even if you sell out of a company, don't be afraid to buy back in, even if the share price goes a little bit higher. But fortunately, I bought back in at lower prices. And this definitely will have a place in my portfolio for the long term. I have no intentions of selling this company now, particularly because it's really exciting that REA Group is having a growing presence in India. That's the main reasons I bought back in. And this is another great chart. In fact, every single chart we look at in this top 30 list is going to have a great chart with the share price going from the bottom left to the top right. Doesn't mean it's going to keep on going up in a straight line, but there is a definite trend when we look at REA Group. And every single time the share price of REA Group gets towards an uptrend, which is that upward sloping dash line, that's the time to buy in. So we have seen it hit that uptrend line about 4 or 5 times in the past, or get very close to that line. First time was in 2015, again in 2016, got very close in 2018, fell through it for a very brief period of time during the COVID-19 financial panic. And in June last year, it hit the uptrend trend line and then bounced off it. So that uptrend line is quite powerful. But we can see the share price really took off after COVID-19, just like every other company on the ASX, it seems like. And the share price went from about $70 at the low, or actually got down to almost $60, all the way up to $180. And I did think at that point, the valuations of this company was a little bit too stretched. And then the share price fell from $180 back to 95. So it almost fell by 50%. But the share price of this company is moving back into an uptrend. So everything is going really well for REA Group. Now, the whole company business model is under a little bit of pressure right now, but this is just, I think, a short to medium term issue that won't affect this company in the long term. Coming in at number 23 is actually a company I more than likely would never buy. And one of the reasons I'll probably never buy this is I do think, in my opinion, this is more of a cult stock. A lot of analysis, a lot of fund managers love this company, even though this company's not profitable. So maybe one of my criteria should have been only profitable companies. But this company has really good revenue growth, and that company is NextDC. They own data centers, that sort of thing. And you notice here, no earnings per share growth simply because they're not profitable. No dividend growth either. Nice gross margins, return on invested capital is mediocre, but really good analyzed total returns of 18.7% per year. So you really can't draw anything from the financial growth, except revenue growth has been quite good because, again, this company is not profitable. More than likely, it will become profitable in the future, because if it doesn't become profitable in the future, the share price of this company is going to absolutely crater. But more than likely, it will become profitable. But I just have a problem valuating or giving a valuation to this company right now because they are not profitable. I probably mentioned that 2 or 3 times already. And as we take a look to NextDC's chart, just another great chart, particularly between 2016 and 2020, 2021. Share price went from about $2.50 all the way up to a high of just under $14, or right on $14. There's a nice little double top up there. And you can see between 2013 and 2016, share price of NextDC went sideways, and then a lot of hype came into this company in 2016, which drove the share price higher, even though this company wasn't profitable. Now, since that first high back in late 2020, share price has really done nothing. In fact, there was a lot of pressure on the share price because this company wasn't profitable. So the share price actually fell from $14 down to $8.50. But we have seen a really good bounce in the share price. over the past 6 to 8 months. Share price has increased from $8.50 back to $13. So in fact, if I was doing this video about 9 months ago, more than likely NextDC wouldn't have showed up on this list. But the share price is moving towards those all-time highs we saw at $14 a few years ago. And if the share price does get above $14, that means it's blue sky ahead if you are just doing a technical analysis of this company. Coming in at number 22 is CSL. Now, this is another company I have had in my portfolio for a long time. I still remember, in actual fact, I sold out of CSL because I doubled my money. I thought I was being really smart by doubling my money, and then the share price kept going up. So I've been an on and off shareholder, but over the past, say, 14 years, generally I have held CSL in my portfolio, and there's good reason for that. Now, there are some negatives about CSL, which I might touch upon in the next few minutes. But when you look at the financial performance of this company, no red flags at all. So all green ticks. Revenue growth, 14.3%. Earnings per share, 13.6%. Dividends, 14.1%. And return on invested capital at 16.5%. So if you just looked at those four numbers, you probably would expect shareholder returns or analyzed total returns to be around or between about 14 and 18%. But you're actually getting 19.4%, which is telling us straight away that has been some multiple expansion for CSL over the past 10 years. And that's been absolutely true. The market right now is willing to pay more of a premium for this company than they were back in 2013. So let's have a look at the chart, and you'll notice a very important thing when we look at CSL's chart over the past 3 or 4 years. We are seeing a bit of a consolidation period. We are seeing the share price go sideways, just like Microsoft did between 2003 and 2013, even though the company is still growing their financials. And this is another brilliant looking chart, particularly between 2013 and 2019, when the share price went from $40 all the way up to $340. So that's an 8-bagger over a very short period of time. But you also notice there was an acceleration in share price between 2017 and 2020. So I've also included the long-term trend, which is that upward sloping line. We probably would expect, and this is making a wild assumption, that the share price should follow that uptrend line. It doesn't always do that, but whenever I see a bit of a disconnect between the uptrend line and the share price, it doesn't surprise me to see the share price go through a consolidation period. And CSL, as I mentioned earlier, has been consolidating, or the share price has been consolidating for the last 3 years, ever since the share price reached a high just before COVID-19 of $340. We have not seen the share price get above that level in the past 3 years. So this could be just like Microsoft for that 10-year period. Maybe we will see CSL share price go sideways for the next 7 years and then take off after that. Now, just today, I'm recording this video on June 14th, the greatest day of the year for obvious reasons. And they did give a bit of an update today. Share price pulled back 6%. So I'm going to have a look at that update to understand why the market sold off. But that shouldn't lead to any panic. Just still means the share price is going sideways. We haven't seen any breakout in the share price, but it wouldn't be surprising just to see the share price of this company go sideways. And the main reason it's going sideways is because the PE ratio got to pretty high levels. And let's have a look at the PE ratio history of this company over the past 10 years. So this is the PE ratio history for CSL. And if you go back to 2013 and 14, the PE ratio for this company was between about 22 and 30. Now, if the PE ratio of this company fell back to those levels, that means the share price would have to pull back a lot unless the earnings increase significantly in 1 year. But you'll notice the PE ratio has been going up through time, which means that is multiple expansion. The market is more and more willing to pay a premium for the company. And that's definitely true for CSL. The market investors are more willing to pay a premium for this company because it is high quality. Now, the highest PE ratio for CSL was when the share price reached its peak back in early 2020. The PE ratio at that point in time was over 52. It pulled all the way back down to 30, and we have just seen a bit of an increase in the PE ratio over the past few years, but generally it's been going sideways during the last 3 years. And that's why share price is going sideways. Even though there is a bit of financial expansion, we haven't seen any multiple expansion. In fact, it's just going sideways. Now, the last company in this list probably wouldn't have made it on this list if I made that cutoff period as June 14, because Ebos Group's share price has dropped significantly in the past week because of a lost contract with Chemist Warehouse. But because the cutoff period was May 31st, Ebos Group made it into this. Now, originally, I had no idea what this company did. I thought they were an accounting group. So again, I have never done any research on this company, but they are not an accounting group. In fact, I should do a video on this company, which is giving me a good idea. But when you look at some of the numbers for this company, I can understand why this has been a successful story on the ASX over the last 10 years. In fact, this company listed on the ASX in late 2013, highly liquid when they listed, but because of financial growth, this company has seen fairly good increase in their share price. But there has been a bit of a disconnect between the financial performance and, again, analyzed returns, and we'll explore that for this company. So revenue growth, 8.6%, earnings per share, 10.2, dividend growth, 13.2, return on invested capital, 9.4. So that is a slight red flag. So if I looked at those four numbers, I probably would expect an analyzed return of, say, between, say, 9 and 14%. But for Ebos Group, it's above 20%. So if you have been a shareholder of this company since they IPO'd on the ASX, you have been a very happy shareholder. And again, the reason why the analyzed total returns are significantly higher than the financial expansion of this company is because of multiple expansion. The PE ratio of this company has grown through time. Now, even though I have not included a PE ratio history of Ebos Group in this video, I just had a look back at their history. So back in 2013, 14, they had a PE ratio of around about 14, 15. And recently, the PE ratio of this company was as high as 31. It has pulled back a little bit because of what the share price has done because of that negative news last week. But again, this is another brilliant looking chart. A lot of illiquidity back in 2013, 14. So this wasn't a well-known company back then. You can see how liquid it was, not a lot of trading, but eventually and slowly or gradually, the liquidity improved. You can definitely see that. And this is a sort of company you want to own, and the sort of company that a lot of fund managers won't own because of that illiquidity issue. So the share price has increased from about $8 to a high of $44, or actually, in fact, $46. So again, this has been a multi-bagger in terms of share price for its shareholders. Very few times we have seen a significant dip in the share price. In fact, what's happened over the last few weeks has been the most significant drop in share price for this company. And right now, the share price of Ebos Group is at a right important, I was going to say inflection point, a really important support level at about, we'll say $32, because the share price did hit $32 towards September, October of last year, and right now it's at that level. If $32 is broken, that would be fairly negative for Ebos Group. But I did notice that the CEO of the company wasn't overly concerned about this loss in contract, and more than likely, eventually they will make it up in the future. So this could be an opportunity to buy into this high quality company at better valuations. And that's all I have for this video, looking at those companies that were the best performed companies on the ASX since 2013. These 5 companies came in between 25th and 21st. So look out for the next video. We'll be focusing on the top 20 companies coming in between 20 and 16. Have a look out for that video in the next week or so. Otherwise, if you have any questions about any companies I featured in today's video, love to hear your thoughts and your comments, and whatever you want to say, just leave in the comment section. That's it for this video. Have a good day. And the last thing I should say is I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.